The Fed's balance sheet, meaning, from 2008, they started this strategy, right, to keep printing money, right, to make sure that economy doesn't go into a slump. And post-COVID, because of the massive economic recession, to reverse that, they printed significantly more money, dollars, and taking their balance sheet from all the way from 4 trillion to 9 trillion, almost $5 trillion they printed over 2020 and 21. That is one of the reasons for inflation peak. Now, after they decided on the policy of reining in inflation, they started tempering down their balance sheet. That means they're sucking liquidity out. This has been their strategy for the past, I would say, from September onwards, significantly at a pace of 100 billion a month. This is a liquidity reduction plan. But then this is also called quantitative tightening, right? Now, the point is, while they did it to some extent from September to around March, April, then the bank crisis hit, and the balance sheet size, which was around 9 trillion, went down to around 8.3, $600 billion reduction. But then because of the bank crisis, again, it picked up suddenly by $300 billion jump. Why? Because they had to do emergency funding. Now, this is important because liquidity withdrawal creates a lot of unforeseen situations in global markets, which you can't right now figure out where is it going to impact. Out of the blue, so many US banks collapsed, right? Small banks. Now, that one of the reasons was draining liquidity along with higher yields. So these two factors are very, very dangerous for markets, which therefore means that in the next coming few months, maybe 3 to 6 months range, if Fed continues to hike rates and keep the liquidity draining, continuing them as strategy, then you do have a risk of a panic event. And the US 10-year yield, which is kind of been very, very stable, is also reacting to all of these factors. Earlier, 10-year yield going up was a positive for the dollar. Right now, that correlation is kind of broken, meaning 10-year yield has been fairly stable, but dollar has continuously, strengthened, weakened, again strengthened back. The correlation is not there. But I think the biggest factor here is the liquidity, the Fed balance sheet, which if it continues to go down the way it is going to right now, in the next 6 months, another 600 billion drain will definitely cause a panic event, in our view. That's one factor we have to keep in mind.
This is one of the reasons why the balance sheet size, so much of money has been printed by US, Europe, Japan, and UK. This money is floating around in the market. That's why in spite of 5%, 4% interest rates in these countries, so much of rate hike, the inflation is so difficult to rein in. And that it remains the question that can rate hike alone without draining this liquidity, can it really control inflation? And if it cannot, then the rate has to remain high for a longer time. This liquidity, the moment they try to drain out, there has been turmoil and there is a risk that it can happen again. So, if you see in a way, US repo crisis, which happened around 1.5 years back, that was a result of liquidity tightening. The UK crisis was a result of obviously rate hike, sharp rate hikes. So these are the becoming now more important points because rate adjustment is still happening. That is, market is adjusting that, okay, rates will be high for a while. But then what are the risks to the market? Liquidity crisis, credit crisis, banks going down, funds going down, those becomes an issue. So this balance sheet is very, very important. We generally look at the interest rate, but we ignore these balance sheet numbers. They have been able to hike the rates, but they have not been able to cut it much. 8.97 to only 8.39 in this 1.5 year period. Whereas they have hiked rates from 0 to 5. Think about it. They are not able to because this money is floating in the market. The moment you withdraw, it's causing trouble. And if it is there, it is causing inflation. Okay.